JPMorgan has raised its long-term gold forecast to $4,500 an ounce and is projecting roughly $6,300 by the end of 2026, citing strong central bank demand and geopolitical uncertainty. Yet today, gold and silver are pulling back sharply on profit-taking, even as US-Iran nuclear talks resume, Russia launches fresh attacks on the Ukraine, and safe haven narratives remain firmly in play. Let's get a sense of all of this and what it's pointing to. John Ing from Maison Placements joins us now. John, a pleasure once again.
Good to be here.
John, JPMorgan is talking about $4,500 gold longer term and roughly $6,300 by the end of this year. Yet today we're seeing profit taking despite geopolitical tension. Does that concern you?
Well, Devin, trees don't grow to the sky. And there's no question about that the performance of gold has been skookum, has surprised everybody. And the reality is we require technically backing and filling. And that's all that we are seeing. There's no question in my mind that the best lies ahead, and gold is going to go much higher. How high? I last published, I guess I was expecting about a $6,000 price. But frankly, I think gold will go higher. And the main reason, frankly, is that, as we know, gold has long been tied to inflation. But in the last couple of years, you mentioned geopolitical concerns. There's Mr. Trump. There's the reality that central banks have been buying gold and continue to buy gold. All of these factors are propelling gold higher. And then we have really the retail public. They have been coming in. They have moved assets, their gold exposure from probably 1-2%. Now we're seeing a double. I've seen as high as 5%. But historically, gold as a percentage of assets have more than 10% of retail investors' assets. So, as I mentioned, the best lies ahead.
Yep. Look, the dollar is firmer and the 10-year yield is around 4%, John. Is the rate story still the real anchor on gold right now? What's your take on that?
Rates are a factor, but there are a multitude of factors that affect gold. And right now, with the U.S. dollar down, notwithstanding the State of the Union address, what's happening is that worldwide currencies now are making an adjustment to the lower dollar. That also affects rates. So yes, there's some short-term movements, but really the driving factor longer term remains that gold has become literally a critical mineral. You have central banks, as I mentioned, buying, and there's just very little supply. And that supply is being, from time to time, and there's gold itself has become short as far as physical gold. And sometimes when there is a shortage, there is a scramble for price. So that's why you get this volatility.
Yeah. Let's talk about silver. I want to get your take on this, right? We saw this sharp surge in January. Very good prices for silver, but it's down once again, leading the downside. John, does silver's volatility signal speculative froth being cleared out? What's your take?
Well, there's no question that there's speculation in silver as well as gold, and in fact, all commodities. That's the nature of the era that we are in. There's just too much money chasing too few assets. Silver, we must remember, skyrocketed ahead, and it had to correct. And the catalyst at the time, you recall, was the threat of an export embargo by the biggest producer in the world, China, limiting silver sales. So again, there are some number of factors at work. Supply, demand, physical supply, demand has affected the markets. In particular, in the commodity markets, when you have COMEX with all the derivatives. And that's why we saw a scramble earlier in the year when COMEX increased margins and in order to bring on some of that silver onto the physical silver onto the markets. So this backing and filling is very much normal. As I mentioned, you don't expect these things to shoot up. They've done extremely well. My point is you have to look at it from a longer term perspective. And really, while it looks like we've had a hockey stick movement, it's really pale in comparison what we've seen in past performance of these commodities.
Mining equities have rallied strongly in recent weeks, John. After today's pullback in metals, do you see resilience in the producers or vulnerability?
I still continue to believe, Devin, that the producers are under-owned. Yes, they have performed extremely well. But again, if you look at history, they should do much better than here. The latest quarter that we saw record margins and record profits. But a disturbing trend, of course, is the increase in their all-in costs. So while the producers benefited and in fact have their balance sheets are terrific, they are buying back shares, they are increasing the dividend. My belief is that these producers will continue to do well. However, noteworthy is that when you look at some of the forecasts for this year, a lot of them are going to be producing less gold. One of the reasons, of course, is that grade has fallen off. The other reason is that they are mining lower grade. But nonetheless, that means less gold coming to the market. There's been a dearth of discoveries, and we still need some new discoveries, but we haven't seen any.
Yep. John, as I wrap up, I got to ask you this. Some on Wall Street are now debating AI-driven deflation risks, right? If growth slows or deflation becomes a real concern, does that ultimately strengthen or weaken gold's case?
This AI literally is a bubble. We've had AI for some time, Siri, etc., Amazon's. The future is fraught with risk. AI can help, but what's really driving inflation, that will drive inflation, is monetary. The Americans are the biggest spenders in the world since the World War II. All of that together with Mr. Trump's decrease in taxes and increased spending, he's the biggest spender of all presidents. All this will translate into higher inflation. And then when we have superimposed on that tariffs, and there's no question that that's inflationary. So this is the undercurrent behind the lift in the gold price. And my expectation is that, as I mentioned before, the best lies ahead.
All right. Well, but thanks very much indeed for those insights. It sounds compelling. John Ng from Maison Placements, thank you for your time.
Okay, Devin.